Hello. So as I've started a pattern of breaking out my equity-oriented commentary versus my fixed income or bond or interest rate-oriented commentary, I'm going to now tackle. I just finished my comments on stocks, and so now separately, I'm going to tackle my thoughts on let's call it bonds. So again, for compliance purposes, statements made during this recording are for informational purposes and are my opinions. They are subject to risk and uncertainty, some of which are significant in scope and by their very nature beyond the control of myself, WealthFactor, and farther. There can be no assurance that such statements will prove to be accurate, and actual results in future events could differ in a material way from said statements. Historical results are not necessarily indicative of future performance. So on the interest rate and bond side of things, uh, the bonds have had a continued slight headwind. And then in the second quarter, we saw very little uh, change from a performance perspective. And so it was sort of an uninteresting or uneventful period if you're thinking about it from an evidence-based investor's perspective. If you're trying to search for reasons to act, there's always something there. And so it's important as you listen to and review some of the information that I'm sharing, it's always from that perspective of being guarded against trying to find reasons to act or things that or patterns in markets because it's human nature to do so. And it's my belief that generally that leads to suboptimal investment decision making when you pursue those sorts of things. So I'll share performance for the bond parts of the market simply, and then I'll put a little bit of perspective around that, and then highlight a new point um, that's recent. It's been a developing or a theme over the last several years, but it's gotten to an acutely high level, which I don't know that there's important ramifications to that, but I'll share some of my thoughts. So 2024, we've seen interest rates go up a bit. And so when interest rates go up, bond prices decline, and that has more or less offset the interest income that investors are getting from bonds in general. As I've probably mentioned before, bonds are incredibly diverse and not all equal. And so that just like with the one from one stock to another, there are certainly bonds that made money and types of bonds that made money in the quarter. And so I intentionally focus when I think about it from an overall markets perspective. When I think about bonds from an overall markets perspective, I intentionally think about that as high quality only and not the more diverse set of potential debt and or bond instruments. And that orientation is driven by the top level investment approach or philosophy, which is if I'm going to take risks, I'd rather do that by owning equities versus low quality bonds that have a high interest payments. Um, Also, from an evidence based investing perspective, if something has higher yield than, say, a treasury, it has some additional risk factor that's there. There's not. So it's so common to see people in general look and search for yield, and it's not always one to one, but I think it's a good rule of thumb to think for every amount of additional yield or interest that you might receive on a bond or a security, there's an incrementally large amount of, or increase in the amount of risk. Okay, so the this is just a little bit of perspective on the year-to-date performance for bonds in general, kind of looking at the decline um, period, and then looking at that relative to how that stacks up. And as we uh, most with a bond or fixed income oriented portfolio probably recall very vividly, 2022 was at the top of that list from a performance perspective over the first 5 months. And then similar to a graph that I shared on the equity side of things, I'm saying, okay, what happened after that? And 2022 was a year where inflation just kept surprising over and over again, and we saw a negative second part of that But generally, outside of that outlier, we see a second part of the year where we've had positive performance. And yeah, so largely bonds are fairly simple from a performance perspective. They're going to be influenced in the short term, which I would define, for any bond that has a decent length of maturity as, a year or less. And the returns are going to be driven by the amount of interest that comes in, and then how much do interest rates rise or fall. And uh, because bonds are issued at par and mature at par, their price dynamics are different than stocks, and because of that, there's an increased likelihood, although not a requirement in the short term, to have reversion in the pricing. So if interest rates rise, they have to, in order for that as an investment to decline again after that, they have to rise again because they have, at least now that interest rates have increased back to healthier levels, they have that interest income that's the predominant driver of the return over the medium to long term. Okay, so now transitioning over to this new concept I want to share, um, and then which is the correlation or the price relationship between stocks and bonds has recently hit a record high, and it was elevated. It's been elevated, a number of times, um, but so for over long periods of time, building a portfolio that has both stocks and bonds has because of correlation, or lack of correlation and potentially negative correlation, has enhanced the diversification opportunity of owning both. And in some cases, you could build a portfolio that had both assets in them that might, or portfolios that were largely stock centric, add bonds which have a lower expected long run return potential and still not necessarily hurt performance. And that was driven by the negative correlation, or low to negative correlation, and the opportunity to rebalance to this negative or low correlated asset, to combine with stocks. But what we've seen recently is this increased correlation between, and this is based on a rolling 3-year correlation. So it's looking at the data over the last 3 years. We've seen an environment where stocks and bonds have more often than they have ever moved in the same direction at the same time, and and so that presents some, you know, it, certain challenges, when relative to kind of the traditional tools that one has in making portfolio-oriented decisions, and it also reduces the benefit that you get from, or at least to some degree, rebalancing. So the from a takeaway perspective, correlation isn't something that really matters over the long run. It's more of a short, something that impacts the decision structure of how you interact with your portfolio. The biggest one being if you're in the position where you're withdrawing money consistently or on an unexpected basis. It's nice to have assets that aren't correlated to each other. So if one of them's down, the other one's not also likely down, and you can choose to avoid selling something at what's perhaps a suboptimal time. So there's a lot of potential complexities that come out of this, and I'm going to intentionally avoid trying to go through those. Uh, but to the extent that this raises any questions or it's of interest to dive in more detail, I'd be happy to on a one-on-one basis. And so please don't hesitate to reach out to me. And that concludes my current thoughts on the on the fixed income part of financial markets.